It's now time to transition to the panelist section of the event, although those are very, very interesting macro views there. It is my pleasure to introduce the moderator for the panel, Professor John Paglia. I had the great opportunity to take his class a couple years back, and in addition to the many accolades and accreditations that Professor Paglia has gained over the years, most recently he's gained major notoriety for his research in the Pepperdine Capital Markets Report. It's received both national and international acclaim. It's been highlighted in the USA Today, the Wall Street Journal, and the New York Times. And so without any further ado, I'm going to pass this on to John Paglia to kickstart the panel section.
Good evening, everyone. It's a pleasure being here with you this evening. And as Alphonse has indicated, over the past, 3 years now, I've been intimately involved with a new project here at the university called the Pepperdine Private Capital Markets Project. And the project itself is an ongoing investigation of the private capital market segments into understanding the behavior of capital providers, the return expectations, and also their outlooks into the future and what that holds. The project has actually taken off much more rapidly than I had anticipated. It's hard to believe, but the first report was published just 14 months ago. And since then, it's received a lot of attention. We've increased the survey response rates considerably. On the most recent survey, which will be released here in a couple weeks, we had about 2,000 respondents across 12 different industry segments. It has provided a lot of very detailed and good information to share with the community. So I'd highly encourage all of you to take a look at that report when it finally is released on October 25th, which will be in conjunction with a national conference in Florida for middle market investment bankers, private equity funds, et cetera. Before we begin, I'd like to introduce our distinguished panel, which includes many people in the industry. They have their feet on the ground on an ongoing basis, and they're the ones who, on a daily basis, live in the trenches. They're able to provide the relevant insights as they occur instantaneously. And we have assembled a wonderful panel that I'm anxious to introduce now. So one by one, I'll introduce the panel, and they'll be placed here to my left. So first of all, let me introduce Eric Manlunas. Eric is a founder and managing director of Frontera Group, a boutique venture capital firm focused on investing in early-stage emerging companies. He began his career as a consulting associate with Arthur Andersen's retail management consulting division. Since then, he founded Interfoods, a venture which consolidated independently owned specialty food providers in Southern California, and SiteStar, a publicly traded technology venture focused on consolidating independently owned internet service providers. Eric earned his MBA from Pepperdine University and his BS in Communications from Florida International University. And it's with great pleasure I introduce Eric to our panel today. Next, I'd like to introduce Stephen Hughes, who's a senior relationship manager for Silicon Valley Bank. Stephen leads Silicon Valley Bank's financial group's early stage team as the senior relationship manager. Silicon Valley Bank Financial Group provides domestic and international commercial banking, investment management, and valuation services to technology companies at all stages of their life cycles. Prior to joining Silicon Valley Bank, he served as founder and CFO of a venture-backed software company, How2TV, and head of Royal Bank of Canada's U.S. Technology Banking Group. He earned both his MBA and BA in Business Administration from the Ivey Business School in Canada. It's with great pleasure we introduce Stephen Hughes to the stage. I'd like to introduce Alexander Suh. Alex is the founder and managing director of California Technology Ventures, LLC, J.J. Jacobs Enterprises, LLC, and Jacobs Capital Group. Alex Suh is a founder and managing director of several venture capital firms that focus on life sciences as well as information technology. He founded and managed several businesses, consulted for nonprofit municipal organizations, and taught college-level entrepreneurship and business and management courses. He graduated with honors from the University of Denver Daniels College of Business with a BSBA in management. Let's welcome Alex to the stage. While he's walking up here, I'd like to start to introduce Luke Johnson, who's a Senior VP of Business Development at Platinum Equity, LLC. As Senior VP of Business Development, Luke Johnson manages leading investment banking and corporate relationship across multiple industries with a team originating over 1,500 investment opportunities annually throughout North America and Europe. Prior to joining Platinum Equity in 2001, he was a director at Kroll Associates, a leading consulting firm in business and competitive intelligence. He holds an MBA from Pepperdine and earned his BS in political science and international relations from the University of California, Los Angeles. Let's welcome Luke. Okay, and last but not least, we're going to introduce David Travers, who's a principal at Rustic Canyon Partners. David Travers brings technology, media, and national security experience to Rustic Canyon, a venture capital firm that invests in transformational companies. Previously, he worked at eBay, where he promoted the growth of its sports, toys, collectibles, and media marketplace, and at the Walt Disney Company, where he evaluated technology and new media venture investment opportunities. David received his BA from Stanford University and then his MBA from the Harvard Business School. Welcome, David. Okay, folks, so what we're going to accomplish this evening is we're going to initially ask each of these individuals what they do. That is, what kinds of investments they undertake, which industries, which geographic territories, what sizes. One of the great things about this particular panel is it is pretty broad in terms of scope of investment opportunities. We start at early stage VC and we go up to later stage VC. We have a gentleman from private equity. We even have a banker. Can you believe that? A banker at a venture capital kind of forum. But we'll learn some very interesting things from a banking perspective as well, and how risk is mitigated in that environment, and how opportunities are existing to entrepreneurs there as well. So we're going to find out a little bit about their investment backgrounds, how they evaluate potential investments, talk about some of the things that have worked very well for them in their portfolio companies, and some things that perhaps may not have worked as well, with an overall goal of trying to understand from an entrepreneurial perspective how we might be able to solicit capital, or how upstart companies might be able to access people such as these in order to make their investment proposals more attractive and increase the odds of obtaining capital and a deeper understanding of how much might be available. And then finally, we'll try to get a little bit of insight on where they think things are headed here. So first of all, what I'd like to do is open it up with Eric and give him an opportunity to tell you a little bit about what his investment preferences are, what they do at Frontera, what the portfolio companies look like, generally speaking, and we'll go on down the line. So Eric, let me turn it over to you.
Sure. So what Frontera does is we're very early in the investment cycle. Our thesis is to be able to fund a lot of these companies that are sort of in your post-angel and pre-VC rounds and stages. We're generalists. We're not specifically we're not targeting any domains per se, but we are targeting where the stage the company is. What we typically do is we fund as part of a syndicate, and what we like in a company is a typical company for us would be a company that has some sort of a proof of concept, some sort of a product that's ready to go to market. but not quite ready for traditional venture capital yet. So we typically like to participate in $1.5 million, $2 million syndicates, wherein it's big enough runway where you can take the product to market, and hopefully wherein you've proven enough, you've created enough milestones and proof points wherein the larger VCs can come in. So a typical company for us would be a company that typically outstrip the funding capabilities of their angel investors, but not quite ready for venture capital yet. And in terms of bite sizes, we've gone down as low as $100,000 per deal to up to $1 million per deal. But the average size per round is about $250,000 to $750,000.
And then, Eric, at that stage, what are return expectations, generally speaking?
Well, just if you ask any VC, they're aiming for the moon, right? So at that stage, we look to get compensated for that type of risk. So to give you an example, we've done about 36 investments since we've been doing this in early part of this decade. We've had about 21 realizations, and in terms of the realizations, we've averaged just sort of 2.5 times our return of capital. We sort of aim for the high end of it. Everybody wants a 10x on their investments, but as a practical matter, you're not going to get that. So we are sort of looking for the low to mid IRR range in terms of, and then 3.5 to 5 year holding period.
Great, thank you. Stephen?
Thanks, John. I'm speaking really from the perspective of senior debt as opposed to equity, which is the instrument that the other panelists would normally address. So with that qualification, the size that we work with is anywhere from $500,000 to about $50 million. The sweet spot, because that is such a wide range, is probably in the $1.5 to $3 million range. With senior debt, we do basically 3 different things. We provide runway extension to really early stage companies. We provide working capital financing to allow companies to finance the growth that they're experiencing. And then for late stage situations, we provide term debt that's designed to leverage the cash flow in the business that could finance acquisitions, as an example. In terms of the range of companies that we work with, it's going to vary tremendously from one office to the next. We are about 90% tech focused in the LA office. As an institution, we're about 70% tech focused. San Diego would be the flip-flop. They would be 70% life science focused. But really, those are the only 2 disciplines that we work within. We've been doing it for about 25 years, and really our value add comes from being focused on a specific industry for a long period of time, understanding the dynamics of the sector, and developing really deep partnerships with the other people that work within the sector. In addition to the debt instrument, because not all companies are seeking to put debt into their balance sheets, we provide a range of services, as John mentioned, valuations, cap table management software, and increasingly a new product that is just rolling out in Q4, which is a data set that allows companies to benchmark themselves against other competitors in the space, whether that's from a valuation standpoint or from an income statement or balance sheet analysis perspective. So it's a range of services that's designed to address the total set of needs that early stage, mid stage, and late stage tech companies have, but really nothing beyond that.
Great, thank you. And Alex, what do you do at California Technology Ventures?
So we primarily manage 2 different funds. One is CTV, which is somewhat of a typical venture capital fund, although we changed the model about 3 years ago, where we decided that the venture capital model was kind of broken, and so we decided to raise our money a little differently. So what we did was, instead of doing a 10-year fund, we did a 20-year fund. In addition to that, we did all the capital up front, no capital calls. So we don't measure on IRR, but we measure on cash in, cash out. The third thing that we did that was different was that we decided to create an evergreen fund to take the profits, if we're performing the way we should be, and putting it back so that we can rotate it and just distribute taxes required for the LPs at the time. So in order to do that, what we decided to do is that we didn't want to become this, we wanted to become global, where everybody at that time, back in those days, were kind of staying in their own backyard at the time. And so, but to open an office in every country that we were interested in would be crazy and very expensive. So we created Jacobs Capital Group, which is a fund of funds. So we strategically invest in emerging managers in various either geographic areas and or discipline areas where we generally like our life sciences and IT, although we've done very opportunistic things like a dairy in China. So we've done from gaming companies, video game companies like Turbine Entertainment that we sold to Warner Brothers. We did Thinglefin, which we sold to Big Fish. We've got a new company called Blade Games that we've funded. We've done medical devices primarily, although we've done also some software, healthcare services, but primarily medical devices with a few therapeutics. And then we've done IT, software, primarily software-oriented companies. We've got a term sheet into a company now that's actually in the university space side, providing social education online. So what we're doing is just kind of all over the board, but to do the investment in the fund of funds, we don't have to hire a big team. And we don't have to have all the expertise in the world. As we say, we're not necessarily MDs or physicians or doctors, which is kind of shocking to people that we've been, knock on wood, lucky to exit out of these deals. But we are good entrepreneurs ourselves. So we know what it takes to build a company, figure out the markets and figure out the type of talent that it needs to put together, and then guide them through the ups and downs. And every company has its downs. And you're going to have, you know, times where you may not even be able to meet payroll. I've unfortunately had to do that as well, and it's a tough experience, so we kind of guide them through that. So that's kind of our process. The amounts are variable, although we try to stick from $1 to $5 million per company. We've gone as high as 10 plus.
Great, thanks, Alex. And next, we're going to turn it over to Luke Johnson, who is going to offer a different perspective as he's representing a private equity firm and even an interesting segment of the private equity market. So I'll let Luke tell you a little bit about that.
I think that's true, John. So I'm going to play the contrarian this evening because Platinum Equity actually focuses on very mature businesses. In fact, we tend to focus more on operational turnarounds and distress. So we're a value buyer. Platinum's current fund is $2.75 billion. We are a generalist firm. We specialize mostly in industrial assets, although we have strong emphasis around distribution, logistics, and technology like software and IT services. But everything we do really is to find opportunities that have operational issues. So typically we're buying divisions, non-core divisions out of large Fortune 1000 companies. So we've acquired from the who's who of the Fortune 500 and so forth. Our bite size today really ranges, it's a very wide spectrum because if you can imagine, because we're buying distressed situations, we actually have companies paying us to take divisions off their hands. But the largest check we have written is $500 million. Our sweet spot tends to be in between 25 and 200 million. And my role personally is to manage the deal origination team globally, and basically I'm out there looking for deals.
Great, thanks, Luke. And then finally, we'll let David share a little bit of information about what they do at Rustic Canyon. And I can only think that, you know, there's one company in his portfolio that keeps him up at night. That is DocStock.com, which happens to be, many of you know, a company that was launched by a Pepperdine alum by the name of Jason Azar. So I'll let David share a little bit on that.
That's right. I'm proud to be on the board of DocStock, and I actually met Jason guest lecturing at a Pepperdine class. So proud to be here. Rustic Canyon is an early-stage venture capital firm based in Santa Monica. We're currently investing out of a $200 million fund. Our average check size is between $2 and $5 million, but we will invest anywhere between $50,000 and $10 million. By early stage, as early as one entrepreneur I was meeting with today, had a great idea and hadn't put anything down on paper yet. Looking forward to hopefully working with him, and all the way through to companies that are well into revenue but have incredible growth opportunities still lying ahead of them. We tend to focus on internet and clean energy companies as the two sectors we spend most of our time on. And in terms of our return expectations, we will not make an investment unless in a reasonable upside scenario we believe we'll get 10 times or more our money.
Excellent, great. Thanks, David. Very interesting. And so one of the things that the private capital markets project has been indicating recently, and this has been ongoing for well over a year now, is that it's tough to come by new investments in the venture capital arena. Many of the venture capital firms have been having issues on the fundraising side of things. Furthermore, portfolio companies have taken longer to harvest than initially anticipated. Consequently, what's happening is a lot of capital has been, deployed towards current portfolio companies in a bit of a triage situation, and the focus has been more towards later stage, which, as an entrepreneur, that creates some challenging fundraising scenarios. So I'm curious from the panel, what are the current thresholds? What are the current benchmarks that must be met in order for new companies to obtain startup capital? So with that, Eric, do you want to lead us off? What's it take to obtain capital from Frontiera?
Sure. So we're looking, as I mentioned earlier, we're looking for a product that's ready to go to market. Historically, we've done some stuff that are sort of the one entrepreneur, a dog in a garage, but the last 3 years, we've really focused on companies that are just need that extra bump to be able to create those milestones. So we're probably not well suited to touch something that's more of a concept at this point. So if there's a product that's ready to market, or a service going to market, and it's something that we can reasonably understand and reasonably believe that it's going to scale pretty efficiently, that's something that we will certainly spend a lot of time on.
And Stephen, from a banker's perspective, how do you evaluate investment opportunities? What's it take to qualify for some debt capital from Silicon Valley Bank?
Great question, potentially really long answer, so I'll try to skip the long answer. If a company is venture-backed, there are ways for it to raise debt capital that are incremental to what can be done by companies that do not have institutional capital behind them. If you are a company that has not yet achieved or does not intend to take on venture capital, then you need to have one of two things. You need to have hard assets that can be leveraged to support the business, or you need to be sufficiently established that you've been able to generate recurring cash flows that can be leveraged to support debt. Those are two things that are required to support debt situations for companies that haven't raised venture. If, on the other hand, you've raised venture, there is this third mode of lending, which is runway extension, and that requires a partnership with a venture capitalist that we know well. It involves raising some debt money that will allow a company to take that Series A round that might have been designed to fund 12 or 15 months worth of operations, and the debt can layer in there to fund another 2 or 3 months worth of operations. The key there is the partnership with the VC.
And Alex, anything to add to that there? And also potentially weighing in on management team as being an important investment criterion?
So I'm going to say something kind of crazy. If you don't need venture capital money, don't take it. If you're going to start a business, figure out a business that does not require venture capital until you absolutely need it, which means that you're profitable in some form or fashion and you want that money for growth. Because if you do take capital from a venture capitalist too early, you're going to get diluted. And in today's market, it's even going to be really, really bad. You're going to lose a good chunk of your company because it is a buyer's market today, not a seller's market. So we can pick up companies for very, very cheap compared to, say, a few years ago but even prior to the dot-com days. So that's the most important thing that I try to tell entrepreneurs. The second thing is, don't think you can run the company by yourself. You build a good team, you have a much greater success potential of getting venture capital money. If it's just you and one other person that has no prior experience, has not shown what they've been able to do in a startup situation, if you're a startup, and can't grow it beyond a certain point, then they're going to be very reluctant. And of course, we're going to ask you, at least our firm does in particular, we will tell you after the first or second, sometimes maybe the third meeting that we have with you, that quite honestly, before we put in a term sheet or before we fund you, we don't think you're going to make it as the CEO long term. You might surprise us, and I hope you do, but the bottom line is we may not think that that's going to be the case. If we don't think that's the case, it's going to matter on how you react and what you do to, quite frankly, convince me. Don't just say you'll change, but to truly mean that you'll change and you'll prove it in a way that makes us feel comfortable. Why is that important? Because the bottom line is it's not technology that fails companies. It's really two things. It's management and your board. I've seen more companies get screwed up by the board of directors just as much as I've seen by management. So those are the two key elements that you really have to pay close attention to.
Excellent, very insightful. Thanks, Alex. And Luke, from your perspective, which is a completely different vantage point, how are you evaluating investment opportunities, and what does it take to qualify for, consideration from Platinum Equity?
So for us, look, we're very operationally focused. We have a team of about 60 professionals that are operators. They've operated companies before across all sorts of functional areas. So for us, we're looking for inefficiencies in businesses. We're looking for margin improvement. Typically, we're buying divisions that have lacked capital for a period of time, or the management team has lacked focus or a clear direction. And we come in, and typically we're finding areas to really improve the bottom line. We actually do buy businesses that are secularly declining. We're okay with revenue declines. What we're more focused on is cash flow. We like stickiness from a revenue standpoint. As it relates to the use of leverage, we're looking for asset coverage. So if there are tangible assets in the business that we can lever against, that will get us comfortable. But ultimately, it needs to be a mature business that is sustainable, even if it is declining. We typically find that businesses don't go away overnight. There's a tail associated with them, and if you can manage the cost-cutting and scaling of the business down or up, you can realize some pretty significant returns.
And that's very interesting. And a look at the portfolio companies that exist within Platinum Equity do indicate that. In a panel like this, talking about some of the companies that they have holdings in probably would make most people cringe. For instance, newspaper companies, the San Diego Union Tribune is one of their investments. U.S. Robotics, some of you probably remember that name from many years ago. Companies in the automotive sector. These are where companies like Platinum Equity find great investment opportunities and do well with those kinds of investments, and they run completely contra to where we think the real hot money needs to be. So it's really interesting, and appreciate you having you here and sharing your insights. David, how about you? Yeah,
I would take a slightly different take than the other guys on your original question, which is, I would, in terms of milestones in order to be able to raise money from a venture capitalist at an early stage, I would think about cataloging what are the core risks to your business being successful and figuring out which of those risks you can take off the table for an investor before they make an investment, and which of those risks you're asking an investor to take on. And one great way, if your list there is too overburdened by issues that you have not been able to take off the table, one great way of addressing that is by strengthening your team, such that if you still haven't proven that you can find a profitable way to market and acquire customers, bring in somebody who's really expert at marketing to that particular segment or market area. And there are lots of other examples of that. But I would really think about how many strengths and weaknesses do you have? How plausible is your argument that the risks you're asking an investor to take on are something you're going to be able to address? And how can I bolster my team before I take on investment to mitigate as many of those risks as possible?
Great, thanks. And now we're going to turn the table a little bit and take a look from the entrepreneur's perspective in terms of evaluating a venture capitalist or private equity firm or bank as a potential partner, because these relationships are critically important. They tend to last on average 5 to 7 years. In some instances, in this economy in particular, it's taking a little bit longer than that. Some stages are a little shorter. But the entrepreneur also needs to do a significant amount of due diligence. And as someone who's starting up a company, typically the focus is generally, where do I get capital? And I'll take capital from anywhere. But there's costs and benefits associated with obtaining that capital. One of the critical costs, naturally, is the amount of dilution, as was pointed out, or the amount of equity that's given up. But in addition to that, venture capitalists, private equity firms, and even banks really should be a strategic partner. They should have some insights into your industry, be able to make some connections, and do some other things that are going to help you along your path of growth. So let me turn it over to, let's start at the other side first, David, if that's okay, if I don't catch you too off guard here. And ask David, what should an entrepreneur do in terms of the due diligence to evaluate a capital source for funding?
Well, I tell entrepreneurs that picking an investment partner is like picking a spouse, except it's much harder to get divorced from your venture capitalist than it is from your spouse. So you really want to do a lot of research into what is this person and what is this firm like, not when things are going well, because almost everybody's great in that scenario, but when things get really tough, as Alex referenced earlier. So you really want to talk to entrepreneurs and get your capital source, your venture capitalist or whomever it may be, to give you a list of entrepreneurs that they say you could talk to about what it's like to work with them, and then look on their website and see what other entrepreneurs they've worked for and call them. Because look for the companies that haven't been as successful and ask those entrepreneurs, what was it like through the tough times? Because that's where you're really going to find out what it's like, and every business is going to have tough times, even if it ends up being tremendously successful. So that's what I do.
Great. And then just kind of as a follow-on to that, what sort of percentage of equity should entrepreneurs or startups plan to give up in exchange for an investment? Can you give kind of a
Yeah, I think in early stage venture capital specifically, somewhere the reality is almost no matter what amount of money you raise, you're going to give up between 20 and 40% of your company. There are rare exceptions to that, but 30% is a good round number as a good guess. The real question is, most people don't realize this, but the real question is how much money are you going to be able to raise based on where your company is and what the growth prospects are for it. So whether you are going out to raise $1 million or $5 million, a venture capital firm is going to look to take somewhere, or two if you're working with two, somewhere between 20 and 40% of the company for that round of financing.
Great. And then Luke, how much equity do you folks typically take down out of the capital structure when you're doing a deal?
It depends, because as I said earlier, there are times when companies pay us, which we like those deals, and our LPs like those deals. But
now, we thought you were joking about that. How does that work?
Last year, Alcoa paid us $190 million to take an asset off their hands, so we can still do those types of deals.
Anyone else want one of those deals?
Now that business was losing $25 million a quarter, so there's a lot of operational risk associated with it. But look, I mean, if you think about our model, we over-equitize, because most of the time the credits are pretty ugly and you can't get 3, 4, 5 times the leverage. So the opportunity for us is to over-equitize, and we'll go as high as 100%. We've done that quite often, in fact, and if we do our jobs right and we can turn around the business, we can recap the business within 6, 9 months and put in a more permanent capital structure. Typical LBO, typical private equity is 30% equity. In today's environment, it's more like 40 to 50%.
Interesting. And then Alex, in addition to weighing in on equity percentages in exchange for capital, perhaps you could shed some light on the valuation process. One of these overarching mysteries to many startups is how venture capitalists come up with a valuation indication. And hopefully you can share the precise formulas that are used to do that.
Draw three lines on the wall, base, top, no, close your eyes, throw a dart. If it goes low, tough luck. No, I think the problem is, I think, quite frankly, even in the funds that we've invested in, everybody has a different model. So some will obviously go back and look at previous exits in other companies, but a lot of that data are probably majority are public companies or companies that were bought several years ago, so they're not the most current data. And if I was to really say the honest truth, the way we do it, it's a gut feel. It depends on what we think the company is going to need in full capital to get to positive cash flow position. So if we invest in a company, we don't look to invest to the next milestone where we think we can get additional capital. I think that's a really stupid way to look at an investment. You've got to look at an investment based on the opportunity. What amount of dollars are you going to totally need to get this company cash flow positive in a very positive way? And so when you look at that, that means you're going to have to raise X amount of dollars because most firms won't put it all in, except for Luke, you know? And so you want to make sure that you understand the dilution process, that we will get diluted, and therefore we'll want more in the beginning so that as we get diluted, we can hold on to more, or it's not worth the risk. If it's a great, like I said, a seller's market, then you have much more ability to get a higher price because everybody's kind of knocking on your door is trying to give you money, like the old days. But that's just not the case today. So you have to be prepared that you're going to take a look at it. And again, I'm not giving you a solid answer as a precise formula because it depends on the industry. It depends on whether you're a biotech company versus an IT company versus a services company versus a consumer product company. All that has variables on the amount of capital and in addition to where you stand. There's a lot of bottom fishing going on today. You know, companies that have great syndicate investors there, but guess what? They're at the end of their life of their fund. And today, many of them cannot raise new dollars, even the big name guys. Or they're raising half or less than half of what they were able to raise in the past. Therefore, it's not there. And they're going to be very, very careful that when they make their investment in order to continue to get money from the LPs in the future, that they give the best returns possible. Now, the good news, though, is that if the entrepreneur is smart about this and is really contributing and adding value to the company, including operating the company in a different role as that may be from CEO or as a CEO, the investors must incentivize you, right? So they're always going to have to relook at the option plans, et cetera, to keep you incentivized because it does them no good to try to strip down the management team spirits and possibilities of becoming millionaires. Why would you do the deal? Why would you take the money? And that's very important to us.
Great. And then, Stephen, I know you don't take out equity chunks per se, but do you get involved in warrants on deals, or are there other incentives or kickers that are attached to the credit?
In the early stage, we do take some form of equity compensation. These are warrants that get attached to the debt deal that we do. That's in that runway extension model that we talked about earlier. I think to David's point of how an entrepreneur should look at the decision about which provider of capital to take, I like to use the metaphor that what you're really doing is hiring a partner, and you should go through the same process of deciding, using mostly qualitative inputs, not quantitative inputs, what the partner that is best for you. And you're hiring their Rolodex, you're hiring their style, you're hiring their character, and those are things that aren't visible through the lens of a term sheet. It's not about necessarily, the best decisions are not about who provided you with the best term sheet. the best ones take into account the qualitative factors. It applies equally to equity and debt. I see lots of folks making the mistake of putting into a grid a variety of term sheets and then going off the grid and saying, well, here's the obvious best choice without including the qualitative factors. It's an easy trap to fall into, and it feels really good for a short period of time, and then you live with the consequences.
And Eric?
Yeah, so in terms of valuation, I kind of look at it from a very simplistic perspective. Most exits out there are sub 50 million bucks. In fact, there's a lot of anecdotal data out there that most exits are sub $30 million. We don't have a bone in our bodies to be part of a $1 billion exit, although it'd be nice to have one, but we don't set our targets to be that high. So what we typically do is when we get involved in a company that we really like, we want to get involved in, we sort of benchmark, take into consideration how many rounds of capital you're going to be raising, how much ownership you want to have up front, and if you benchmark this thing to be a $30 to $60 million exit, are you achieving the target return that you've been mandated by your investors? Having said all that, a typical deal for us would be sub $8 million valuation, and we would be part of a $2 million initial round, and we would follow our investment if we have to, although if there's been a significant uptick, we would choose not to take down a pro rata round. But to give you just, that sort of came out of necessity. I was a two-time entrepreneur. I've built and sold a couple of companies in the past, and that's the way I've kind of looked at life. That it's pretty silly to benchmark yourself to be a Warren Buffett. So you kind of just have to figure out, okay, what are the basic parameters of having a modestly successful exit? And as a practical matter, most of those companies are between 30 to 60 million bucks or 30 to 50 million bucks. So we do some sort of a regression analysis, but again, it's not a science per se, it's more of an art. But so we have a pretty set box, and if there's a company that we really like, but the entrepreneur has such a halo that he can command a 20 million pre as a PowerPoint company, that's probably something that we'll just walk away from.
Great, thanks. And Stephen, I'm going to throw a question out to you about business lending. As you're well aware, just signed was a $30 billion bill to stimulate investment in small business lending. And I'm wondering, what you see on the horizon as a result of that coming into play at Silicon Valley Bank, but also more generally for small businesses and the economy.
Let me first say that I don't speak officially on behalf of my institution when it comes to answering that question. So this is my guidance, not anything that's been endorsed at a higher level. I think the premise of that bill is pretty fundamentally flawed. The idea is that there is a set of banks out there that are basically zombies. They are undercapitalized, they have flawed business models, they have a history of making not so great decisions, and that bill is designed to put capital into those institutions so that they can leverage that capital and then lend it on to small businesses. But it seems like that's not the best strategy for getting capital efficiently allocated to the folks who can use it best. We're using the medium of some folks that are unsuccessful, and repeating that process seems to be pretty close to the definition of insanity. Was I immoderate with that?
What would you recommend as a follow-up? Is there something that you've contemplated that you think would be a good solution? What would you propose if you were in that position, if you've given it any thought? And I know I'm catching you,
off the top of the head. I think models that reward success are probably going to do better than ones that reward failure. And so there are some institutions out there that have proven they can manage their business well, and feeding capital into those who've proven that they can allocate it efficiently and manage it well is more likely to work than the one that we've developed.
Yeah. Great. Thank you. So kind of turning to the future a little bit here, I'm wondering what sort of promising types of companies, technologies, developments are you seeing on the horizon that you think are real investment opportunities today, but even on a grander scale, potentially of such magnitude that they could lead the U.S. economy out of the doldrums that we've been witnessing for some time now. How about we start with you, Eric?
I think my default answer to that would be something that would catalyze a lot of job creation, although it's not something that we do. It's still a black box for us, which is sort of clean tech. It's a very capital-intensive industry that I believe Rustic does quite a bit of. So Dave might be a better person to answer this question. But in terms of what we're looking at, in terms of sort of the next evolution of technology, we're fairly bullish on cloud computing, which we've been doing for the last 3 years now, and we're looking quite a bit in that segment as well. And we're quite curious and interested in the whole migration of computing into the mobile handset. So we're pursuing a couple of investment theses that would be along those lines, and I think a lot of the interesting startups will be in that sector, and hopefully create and catalyze a lot of job formation.
Stephen, anything to add there?
No, I think those are the big themes of clean tech, cloud computing. I might add and mobile, of course. I might add security to the list. I think that especially as we see more investment in mobile technologies, defending the handset from the things that we've been defending PCs against for a while will be a growth opportunity as well.
Mm-hmm. Great. How about you, Alex?
Drugs, rock and roll, and porno. Unfortunately, we don't invest in those areas. But that's a cash cow, right? So
just personally, right?
Yeah, just personally. This is being filmed. No, I think the bottom line is I don't think there's a solid answer out there. I mean, you know, who thought Facebook was going to take off the way it did out of Harvard and stuff? I mean, quite honestly, in the beginning, it's gotten huge momentum and obviously is becoming a major market mover, if you will, in a lot of different industries. But you don't know for sure. I mean, that's the fun part about this business is you got to diversify, and you've got to look at the bottom line. Can this be a business in itself? And if it can't make money first, then it's not something that you should just throw cash at and hope it'll stick to the wall and become a big, you know, Google or whatever. When Google first came out, we didn't actually look at it. I started to actually do research to pursue it, only because in those days, you know, you had Yahoo was the gorilla there, and you had about two other, which I can't even remember the names anymore, big search companies that, you know, had the market. And so what were the chances of a thing called Google taking over? But the funny thing was, every company I went to and every employee I visited, I saw on their computer Google. And they were using it over and over and over and over and over and over. They weren't using Yahoo. They weren't using, you know, the other companies that were out there at the time. And now, look what happened. So those are the kinds of things that we kind of look for, where people are driving things that people haven't quite noticed yet. And that's what we kind of like to look for.
And Luke, 20 years down the road, when these new technologies fail and start to decline, what are you going to be looking to invest in?
That's a good point. Look, I love venture capital. I love innovation because as you have emergence in new technologies, there are technologies that are being dislocated. And so what we tend to gravitate towards a dislocation in markets. And as you think about technologies, whether it's cloud computing or other areas, you know, there are still very sustainable software applications, communications equipment, and other types of technologies that are viable and will be viable for the long term. You have to remember, companies today are strapped for cash and don't have the capital to be able to invest in new technologies, so that extends out the life cycle for some of these more legacy technologies, as we speak about. Those are viable opportunities for us. And you know, outside of technology, themes that we're seeing, one area is media. There's obviously new content delivery around media and emerging technologies for digital media. Well, people are still buying newspapers. You know, people still read newspapers. We own one. We took a business that was unprofitable. It's profitable today. We just bought a distribution business of CDs and DVDs. You know, people are still going to go out and buy CDs and DVDs for the next 5, 10 years. People don't think so, but, you know, provided we can scale it, which distribution is very scalable, you can make a return doing that. So, all the more power to my peers here with the innovation side, because there will be dislocation on some of the more mature technologies and other types of markets.
John, can I add something to that?
Yeah, absolutely.
So we did an investment, which people thought I was nuts at the time, and sometimes I still do, in China, which was a dairy farm. And they said, well, Alex, that's not life sciences, that's not IT, that's not, you know, your sweet spot, and what do you know about cows? I don't. You know, I know they give milk, and that's about it. But what was interesting about China, when we looked at it and studied it, and we actually did due diligence for about 3 years on the management team and really getting to know and understand the management team completely and their investors, plus the opportunity, which was huge market. People who thought lactose intolerance in Asians meant that they won't eat, you know, dairy products is not true. In fact, Haagen-Dazs is one of the #1 selling ice creams in China that's going for a little quart that you would buy at the store here for $5. The same thing is selling for $20 in China, where they can't afford, most people can't afford that $20. A little serving is $7 to $8. It's mind-boggling. And the bottom line is what I sold to my partners was that, look, go back in a time machine, take existing technologies, RFID tagging, database management, real drugs, not herbal drugs for treatment of disease, et cetera, and go back into an industry that has a lot of potential and growth that hasn't been worked on and hasn't been modified genetically or anything else, and apply those technologies today. And we are probably one of the more profitable, pure, high-quality dairies in all of China. I mean, we have standards in terms of bacteria count lower than US standards. It's that good. And so we have people coming from all over the world visiting the farm trying to figure out, how did you guys do that? I mean, what was the miracle? And the funny thing was, none of the entrepreneurs knew anything about dairy. They were IT people. And that was a huge risk. But like Luke was saying, you take traditional old stuff and apply it in technologies and opportunities, you can find some very interesting opportunities by just doing that. And that's what we did.
Great, thanks, Alex. And after we hear from David, we're going to open it up to the audience for any residual questions that you may have. So you might want to start thinking about some things that you're dying to ask this esteemed panel. So back to our initial question. David, I don't remember what we were talking about, but I'm sure you could expand.
What's hot now, I think, is the... So I agree with a lot of what's been said. We're big believers in clean technologies being a big area that will drive growth for the United States and provide incredible opportunities for entrepreneurs and for investors. But as entrepreneurs out there, if anyone is considering making the leap to being an entrepreneur and an innovator, my advice would be you want to zig where everyone else is zagging. So I was up last week at a conference in San Francisco called TechCrunch Disrupt. Every company had to do with copying or doing something adjacent to Twitter, Groupon, or Zynga. And those are all great companies, and I'm sure some of those companies starting up there will be very successful. However, there are so many opportunities that lie outside of what's hot right now that I think we will, whether it's the unexpected growth of Facebook, it's very likely, or something else, it's very likely that what is going to power us forward and the next great entrepreneur and 10 entrepreneurs in this country are going to be doing things that we wouldn't sit here and anticipate doing. So I would encourage you to think differently. If you're interested in clean tech, there's a ton of people thinking about biofuel and wind. Not very many people are thinking about clean coal right now. Saudi Arabia, China is the Saudi Arabia of coal. They're firing up 3 coal plants a week. Somebody needs to figure out how to make that clean. It's not as sexy, but there's a big market for it. There are tons of opportunities out there like that. So I would encourage you to think differently, not think about what everyone else is doing.
Very good advice. Zig where others are zagging. And on that note, why don't we open it up for some questions from the audience here? If there are any. Okay. We got a couple over here.
A lot of VC activity is concentrated in a couple places, like San Francisco, Boston, for example. Maybe you can talk a little bit about operating as a venture fund based out of LA. And then just a follow-on question to that, we've also seen, Groupon coming out of Chicago, Foursquare out of New York. Can you comment on maybe Silicon Valley as that dominant space for new tech, and is that going to decline as well?
I'll take it and let others follow on. So in reverse order, I don't think anyone's going to dethrone Silicon Valley anytime soon. The infrastructure that they have up there is incredible, and that takes a long time to build. However, LA and Southern California more broadly is actually booming. I've been in this business down here for 5 years now, and the difference over the past 5 years, despite where the economy is from a macro perspective, there's an incredible esprit de corps among early stage internet entrepreneurs in Los Angeles. There are an incredible number of new ventures starting, and I would say actually, despite it being difficult to find funding in certain sectors, getting an angel round of $1 million or less done for an internet company right now, there's almost a bubble going on, not only in San Francisco, but even in other places. So, and I think the statistics back it up in terms of recent quarters of venture capital investment. I think $1 billion were invested in Southern California in the last quarter. I think other areas like Chicago and New York are doing well also, but I think LA is in the early stages of building some incredible companies.
Yeah, I think in terms of volume, LA is still number 2, even though nobody really talks about it. Everybody kind of talks about Boston and Silicon Valley, and to a certain extent New York. But in terms of volume, as Dave said, $1 billion for Q3 is again, I haven't seen. I heard the number, but I'm pretty sure it's second ranking to the Bay Area.
Yeah, I think statistically, Southern California has now had 3 consecutive quarters where it's been the second most active VC investment market. So we had a couple quarters prior to that where we weren't, but the 6 quarters prior to that we were. So we're pretty much entrenched as the second largest VC market in the country. And I think, while I don't have the numbers for it, that would probably qualify us as the second largest VC market in the world.
Another question.
Clean energy, and more particularly broader, the green tech, is probably one of the bright spots for technology development over the next 10, 20 years or longer. We're really in the infancy stages. A lot of interesting stuff coming out of the universities. But they're much longer runway than most technology developments, even biotech ones. It's really 10, 15 years minimum that we're seeing to get those to break even or some sort of commercial use, which lands many of those companies in the valley of death, it's called, in the funding. Where do you see how we're going to fix that problem, that valley of death, so more of these green technologies can actually get to some sort of commercial use?
I think actually that it doesn't necessarily take 10 to 15 years to get to cash flow break even. But what is required is for substantial investment the way life sciences receive substantial investment in academic settings to do the early stage technology development, and then a path to transfer out to commercialization. And there hasn't been the same history in clean tech as there has been in life sciences where that tends to happen. I think it is starting to develop. It will take time, but I think there are, and there will continue to be, despite the impression and the general impression that it takes 10 to 20 years for a clean tech company to make it to $1 big significant exit in the public markets, I think there are several companies coming up over the next few years that will debunk that.
So I'm not saying this about Rustic Canyon, but I'm just saying about clean tech in general. In my opinion, we never raised a clean tech fund. We look at clean tech on occasion. We have not done a clean tech deal. There's a lot of opportunities. There's a lot of challenges as well. I think you're exactly right that, you know, whether it's 10 or whatever years, I mean, how many different biofuels, how many different solar panels, how many different wind things can you do and predict who's going to be able to be the winner going forward is I think, going to be something that these funds are going to learn that may have been a mistake. I think a lot of funds make the mistake of trying to raise money based on a new trend. So if you remember those nanotech funds, you know, where are they today? When we did life sciences with IT prior to 2000, all our LPs said we were nuts. They said that they would give us triple the amount of money that we requested if we did not do life sciences and only did internet and IT because it was the biggest boom and people were just throwing money left and right at it. And we said, no, thank you. We decided to make sure that we did both for diversification at that time. And to tell you the bottom line truth, we are a profitable fund returning capital to our investors. And had we not done life sciences, we'd be dead in the ground like a lot of other funds. And so you got to be careful about those funds that kind of transition to raise money. Do they really see where that magic is going to come from or not? I'm not saying it can't happen because there's a lot of need and a lot of opportunities to allow technology, but it's got to be looked at in a very different way.
Anything else to add?
No, I'll just say we're investing in oil field services, so
Yeah.
it's still a very viable market.
Thanks, Luke. Okay, Nicole, I think you had a question. I think you were next.
Thank you.
My question is, I read an article in Business Week Bloomberg about whether or not fashion and private equity look good together. Talked about the Apex Partners deal with Tommy Hilfiger, and I think they made 4 times their money on that deal, and that's very unusual for private equity and fashion apparel to work that well together. I know you guys are invested in media and entertainment. Would you ever take a stab at that world, or is that just too risky?
Too risky. We don't do in consumer businesses. We're more B2B, so we're not comfortable. We think consumers are fickle, and so we like tangible, recurring revenue, contractual revenue, hard assets. So unfortunately, I can't really comment on the fashion side of things.
Isn't the San Diego Union Tribune a consumer business?
True, but we bought a nice piece of real estate with that business.
Very
So
clever, very clever.
It's an interesting story, to be honest. We bought a newspaper that was losing $12 million a year, but it had a nice piece of real estate in La Jolla. And we bought the business for less than the real estate value. And since we've owned the business, we've actually cut some costs and invested in the business through some pagination systems. They were still having 40 people physically paginating a newspaper daily. You know, so we brought them into the 20th century, is what we say. And today the business is profitable to the tune of 25 million run rate.
That's phenomenal.
And we still own the real estate.
Wow, that's a success story.
Yeah.
Yeah.
Excellent. One man's trash.
Exactly.
We have time for one last question, so why don't we go over here and then we'll conclude.
One of the technologies that I've always been interested in is one that can apply to many industries, and it already has, and that is nanotechnology. What do you see the future of nanotechnology, and just, just curious to see your thoughts on that. As far as, the future, I mean, because nanotechnology has the potential to revolutionize different types of industries entirely, the medical industry, and I'm just curious.
Oh, yeah, absolutely. I'm not, well, my comments earlier were not to knock nanotechnology itself, It was more to knock the funds that were raising funds just because they became nanotechnology experts. And nanotechnology is actually being used in many other things today that people haven't thought about. And the biggest problem, though, when nanotechnology first started out is, you know, you're looking at, I mean, we looked at a nanotechnology company that was potentially going to be applied for using for counterfeit type of items, where there were nanoparticles of gold, silver, and platinum embedded that you could put into tables, into medicine, into other types of items that you could literally scan with a unique identity to identify whether or not this product was counterfeit or not. And we looked at it, but the problem was, you know, it's like kind of RFID tags when they first came out. It's a commodity. It's, you know, 10 cents a tag, $1 tag. I mean, how many tags you'd have to sell, and by the time the market accepted it and learned it was probably way too long for a venture capitalist. However, in nanoparticles and fibers and stuff like that, again, if you can show a model that shows volume and fairly quickly for practical applications, that's a company that I would fund. Absolutely. And even for medical devices. I mean, some of the nano stuff for medical devices is just unbelievable. We had a company that we actually sold to Ethicon, a Johnson & Johnson company, that used nanoparticles for healing of surgery. You could literally cut tissue or an organ by clamping it down. It sealed it at the same time while cutting it with a scalpel in one move. And when you pulled away, there was no cauterization, there was no burning, there was no collateral damage at all. It was just clean, fast, and simple. But if it wasn't for particles, so I guess I did do a nanoparticle deal, but it was really a device deal. We didn't call it a nanoparticle deal.
Any other comments? Great. Well, that concludes our session for this evening. Thank you, panelists, for joining us and for offering your expert views on your particular capital segments, as diverse as they are. And once again, thanks to Dr. Vardiabasis for his keynote presentation, and to the Graziadio Alumni Network, the LA chapter in particular, and Alphonse Lordo and Jesse and the rest of the team here. It's been a great event, and thank you all for coming out and listening. So that concludes this evening's session, and I'm sure Alphonse will be in touch with anything else that may be relevant going forward. Thanks so much.